This is The Street on BNN, and the stock market opens in 1 hour from right now. Will it trade on these numbers, Linda?
Possibly. We have an upward revision to U.S. GDP, 1.3%. It's the estimate for growth for the second quarter. Previously, it had been given to us as 1%. Also, more significant, the estimate for consumer spending has been revised higher, up to 0.7. Previously had been 0.4. The market was not looking for a revision. Now, this is also interesting. We have a drop in jobless claims, a 37,000 drop in jobless claims to 391,000, well below 400,000. But before we get excited, the Labor Department is saying this is a technical calendar issue. They're making that clear.
What?
Not sure what it is, but basically they're saying this is not really less people claiming benefits. It's how they calculated it.
A technical calendar issue?
Technical calendar issue, basically.
Well, that's
So
unusual.
don't get too excited about it.
Okay.
All right, well, let's get some reaction from Pavel Begun, who is the managing partner at 3G Capital Management. Good morning. What's your take on these numbers?
Well, you know, I think my take is that that's a useful number to have, and it's great to see it growing, but I wouldn't get overly focused on it, because I think in all reality, what matters is long-term GDP growth. So, and that one data point doesn't really tell you what the GDP is going to do next year or the year after. So I would just say that in terms of long-term performance of the market and the impact of the GDP number on that, you really should try to look out a couple of years or a few years to see what the long-term GDP is going to do.
I was going to say, what, you know, one data point for sure is too little, but what gives us a good arc? What gives us a good time frame to look at? You're saying years, eh?
I'd say years, yes, for sure, for sure. I mean, anytime you look at equities, you have to measure it in years. I'd say 3 to 5 years at the minimum.
Wow.
You know, yes, I agree. No data point in itself matters. However, if you look at this, you can see some behavior. One thing is that government spending is coming off this, which is something we'll drag on for years. That one's down. Also, if you look at the software investment, I find this number so disappointing. Equipment and software only up 6.2% in the quarter, despite low interest rates, despite supposedly encouragement to business. Is that something that's going to turn around?
I think at some point it will. That's just the nature of things. I mean, you look back 100 years, 200 years, you know, you always hit problems, but in the end, you work on them, you move forward. That's just the nature of capitalism.
But Pavel, you know, we talked about this as being one data point, and we talk about the importance, of course, of looking at long term. What about fourth quarter? I mean, because we did go through so many dismantling events in the summertime. Do we have a more normalized period between now and year end? And what's your forecast on that front for GDP?
You know, it is hard to say, but, you know, from what I've seen in some of the business that we own, things are coming back. That pace has slowed somewhat, but so far they've been coming back.
What specifically? Because we are hearing from corporations some better numbers, guidance moving higher, you know, more store expansion. What specifically are you looking at?
Well, basically, we just look at number of things sold by our businesses. So let's say, you know, you look at companies that make carpet. Well, are they selling more carpet? You look at companies that, let's say, sell, I don't know, some sort of widget. Are they selling more widgets? And the answer is yes.
So what's causing jobless claims to be as high as they are? Yeah, we know you don't have a whole lot of hiring, but still, jobless claims, people claiming benefits for the first time, really stuck well above 400,000. Are companies still paring back employment as they sell more?
Well, I think companies are still concerned. They're not 100% sure about the strength of the recovery, so they're just playing it safe. They're basically saying, look, let's just try to do what we can do with the number of people that we have. And then once they get more confident about the economy going forward, there is going to be more hiring.
Certainly, we see the Dow futures up 123 points right now. Is this report strong enough to warrant the market shooting higher like this?
Well, you know, I wouldn't get too concerned or too focused about the short-term reaction of the market.
Right, this could be a reaction to the German parliament passing
exactly. So it's just really hard to...
or else the jobless claims numbers, too, which is atypical. It's like once or twice in the last 6 months, it's gone below 400,000.
Well, that's true. Yes. Calendar issue or not.
Yeah.
Listen, one of our producers was speaking to you, and you have a very interesting take, Pavel, going back to like the origins of the United States, saying all of the problems they've had to overcome, Civil War, Great
World
War,
Wars, the Great Depression.
Always able to come back. And is that fundamentally because it is a capitalist society?
I think that's pretty much the reason. You go back all the way to 1776, and since that time, the U.S. has always had problems.
Yeah.
Like you said, you had Civil War, you had the Great Depression, you had World Wars, but they have always come back. And I think that's just the nature of the American society, because they have certain ingredients that are still present today that make it so resilient. And I bet that track record continues going forward.
Very good.
What's the timing of that turnaround, do you think?
You know, if we're talking the market, it's impossible to predict the exact timing. I don't think anybody is going to give you a specific time frame, but I would say if the valuations are low enough, it's going to happen. I can assure you of that. Whether it's going to be 2 months or it's going to be 2 years, hard to say. But I say just looking at the valuations today, they're relatively low. You look at the P/E ratio for the S&P 500, you're looking at about 12 times. Well, that compares very favorably to the historical average of 15 times. You look at the earnings yield on the S&P 500, you're looking at 8% versus 2% for a 10-year treasury. So based on that, you can tell that the market is going to do well going forward. So equity investors should realize relatively good returns over the long term. And I think the flip side of that those people who are holding on to treasuries, they're not going to do so well compared to equity investors.
Very good.
Great. Thank you for joining us this morning.
Thank you.
That was Pavel Begun, managing partner at 3G Capital Management.
And of course, BNN economist Linda Nazareth also with us today. Lots to get to in this final half hour here. The TMX Group still in the crosshairs of the Maple Group. How's that going? We'll talk about that and other things when The Street continues in just a minute.